Hello everyone and welcome to the quickfire revision for buyback and shares with differential rights as a part of your paper number 5 Advanced Accounting CA Intermediate. So this is a fairly important chapter, has around 10 to 15 marks of weightage in your exam. Almost every exam we see a 10 or a 15 mark numerical question comes, and sometimes even a small theory question of 2 or around 4 to 5 marks also lands up from this chapter. So definitely very scoring, definitely very important. So we will do a quick revision of the legal provisions. We will do the limits. There is no solving over here. It is just a quick concept refresher video. So what is buyback and what is it that we are going to cover in this chapter? So we are in this chapter going to cover buyback. Within buyback, there are two typical types of questions that institute asks. One is the type of question where it requires you to pass the journal entries and prepare the balance sheet. So it will ask you to pass the journal entries and prepare the balance sheet. And second is a slightly more tricky type of questions where it tries to test you on the limits up to which buyback can be done. Apart from this, you have shares with differential rights. Over here, the institute can ask you a theory question on what are the shares with differential rights, what do you mean by them, what are the legal provisions. So that can be a theory question, or calculation of the percentage stake in case preference shares also get voting rights. So these are the four types of questions that can come in your exam. Okay, so we will first go to the buyback part, which is the more important part. So what is buyback? Buyback refers to buying back your own securities. And this is governed by section 68 as well as section 69 of the Companies Act. Why would a company do buyback? Among other things, it is going to do buyback in order to increase its EPS, in order to utilize its surplus cash, or maybe even to increase the promoter stake. So these are some of the potential uses of buyback. It's a slightly theory based situation. Now, what are the legal provisions? What do section 68 and section 69 of the Companies Act tell you? Well, they say that the buyback is possible only if it is authorized by the Articles of Association. Otherwise, buyback cannot be done. Secondly, buyback is possible for companies after they pass a special resolution in a shareholders meeting. Based on the special resolution, you can buy back up to 25% of the share capital, reserves, etc. However, if you don't pass the special resolution, through a board resolution as well, 10% of the share capital can be bought back even without the passing the special resolution. In the exam, if nothing is given, we will always stick to the 25% limits and not to the 10% limits unless the question specifically forces us to do that. Then we will study the limits in some time. Then we need to remember that buyback has to happen of shares which are fully paid. So if there are certain partly paid shares, you will not buy them back, or you will first make a call, make them fully paid, and only then can the buyback happen. Another legal stipulation is that once a buyback is done, then over the next 12 months, you cannot do another buyback. So there is a 12-month time gap within which you cannot do the second buyback once one buyback is completed, and the shares bought back have to be destroyed by and cancelled by the company within a period of around 7 days. So these are the legal stipulations, can come from a theory standpoint. Limits we have not specifically discussed. Now, if we look at the accounting entries, how will you pass the accounting entries and what are the provisions that you have to remember? Well, buyback over here will reduce your share capital. So it will result in reduction of your share capital base. So once the buyback is announced and you are going through the buyback process, you will debit the share capital, equity share capital, by the face value. However, it is not necessary that the shareholders agree to give back their shares at face value. Maybe a share of rupees 30, a share of rupees 10 may be bought back at 30 rupees, and hence there is a premium of 20 on buyback. So your journal entry will be share capital account debit by the face value, premium on buyback account debit 20 to, let us say, a temporary account called as a share buyback account, or any other name you can give, 30 rupees. Okay, sir, what will you do with the premium on buyback? Now, premium on buyback has to be written off. It will be written off against which ledger? Well, as per section 52 or 53, I guess, of the Companies Act, one of the potential utilizations of the securities premium is buyback, and as a result we are officially permitted. Preference shares is slightly dicey, but for equity shares we are directly and unconditionally permitted to utilize the securities premium for writing off the premium on redemption of preference shares. Okay, so we will try to write off the premium on redemption of preference shares first through the securities premium, and if you do not have adequate balance in the securities premium, then through other revenue reserves like a general reserve, like a profit and loss account, which are freely available for distribution to the shareholders. Okay, so over here your entry for buyback, as you can see, is buyback equity share capital account debit face value, premium on buyback account debit, that is to the extent of the premium, buyback price minus the face value, and a temporary account share buyback being created. If you have to write off the premium, there are 2 or 3 other entries given, but if you have to write off the premium, you will write off the premium first from the securities premium, and if that is not available, from the general reserve, and if that is also not available, from the profit and loss account. Sir, is it legally stipulated that you have to go in this order? No. You can go in any order, though this is the order which the institute typically prefers, and hence we also stick to this order. Sometimes the institute directly, instead of debiting the premium on buyback, it directly debits the securities premium. However, doing this longer method is foolproof. We have also given an exam note on what needs to be done. As we have mentioned, this is the order that needs to be followed for the premium on buyback. Now, sometimes you might not have enough money for the buyback. So what can you do? You can probably sell some investments, in which case a journal entry is bank account debit to investment, and then profit or loss on sale of investment will be the balancing figure. Or you might actually do a fresh issue. Now, fresh issue can be done for a different category of shares. Like if the buyback is happening for equity shares, you can do a fresh issue of preference shares. Okay, so the entries over here will be bank account debit to preference share capital, and if there is some securities premium, then so be it. Or sale of investment, standard entry. Now, buyback will result in a reduction of share capital, and once any transaction results in a reduction of the capital base, which can be redemption of preference shares or buyback of equity shares, there is a legal requirement to create what is called as a capital redemption reserve, or CRR. Now, the CRR has to be created from free reserves. Free reserves would refer to the distributable profits like general reserve, like the profit and loss account, like the revenue reserves. So you will create a capital redemption reserve. We will not ideally touch the securities premium over here. We will directly take the capital reserve, we will directly take the general reserve or the revenue reserves or the profit and loss account and create a CRR. Okay, but you will create a CRR up to what value? Well, CRR will be created to the extent of the face value of equity share capital bought back. Achha, if there are preference shares as well, then face value of the preference share capital redeemed, premium irrelevant, minus the face value or the paid up value, as a case may be, of fresh issue of share capital, which in this case will be preference share capital, if any. In most of the questions this will not be there, but in some of the questions the institute might have a fresh issue of preference shares, also a fresh issue of debentures. We have to ignore the fresh issue of debentures for the CRR calculation, because debentures don't increase the capital base, preference shares increase the capital base. So if you have bought back 10 lakh shares at the rate rupees 10, and you have done a fresh issue of preference shares to the extent of 2 lakh shares at the rate of rupees 10, and as a result this will be 100 of reduction in capital base, which is compensated by 20 of increase in the capital base, and hence CRR will have to be created for the 80 rupee balance. Remember this, you might even have studied this as a part of redemption of preference shares, paper number 1. And then after everything is done, or even before that, you can pass an entry. Once you have adequate cash, you can do the share buyback account debit to bank, and that way your entire buyback process is done. There are a few questions where institute has actually twisted the cases, where it has also included certain transactions like bonus shares, or certain transactions like redemption of preference shares, or redemption of debentures, or cancellation of owned debentures or ESOPs, which are from other chapters. So they have included one small adjustment as well. If you're comfortable with the other chapters, you can very easily solve it. No additional complexity that buyback brings along with. Okay. Now the next important section over here is the limits. We had not discussed the limits of buyback. There are three limits that you have to remember for the as a part of the buyback process. First is the shares outstanding limit. Your maximum buyback, maximum shares that you can buy back is up to 25% of the number of shares. 25% of the number of shares. Okay? Or the resources test, where how much maximum money can you dedicate towards a buyback? Well, that is 25% of the paid up share capital plus securities premium plus the free reserves. Acha, free reserves would mean general reserve, revenue reserve, profit and loss, which are freely available for distribution as dividend. Items like revaluation reserve, infrastructure development reserve, or capital reserve do not qualify over here. So this will give you the maximum rupee value that you can spend behind the buyback. Acha. However, we want to find the number of shares that we can buy back, in which case we will have to divide this by the buyback price. This is best understood numerically. We're just doing a quick revision. And third is the debt to equity. The debt to equity ratio over here after the buyback should maximum be 2:1. How do you ensure that? Well, we have discussed the logic probably in the lecture. However, if you want to remember the steps, what will you do is you will write down the existing debt. Let us say the existing debt is X rupees. You write that down. Second, you will find out the minimum equity that you need to maintain the 2:1. So whatever is the debt amount divided by 2 will give you the equity that you have to maintain. You will compare that with the existing equity, and when we look at existing equity, it is same as calculated in step number 2, that is the paid up share capital plus the securities premium plus the free reserves so this will give you the existing, which means, for example, if your existing debt is 1000 and your minimum equity will be 500, but your existing equity over here is 1800, which means you have the potential to take the equity down to 1500. 1300 अपन और नीचे लेके जा सकते हैं. We can take this down by 1300 rupees. So over here we will have to build a simultaneous equations. Well, if the equity falls, we will say, okay, what is to calculate? 1300 is the resources which you can dedicate to buyback. No, you can't, because some of the money will have to be some of those resources. Why would equity reduce? Well, if you buy back, share capital gets debited, equity will reduce due to the premium, which is return of against securities premium or free reserves, for which you will have to pay money. Equity reduces, or it can also reduce because of CRR, because of the transfer to the CRR. Okay, so CRR is not what you are utilizing for the purpose of for the payment to the shareholders as buyback. So what you will do is let the CRR amount be X. You can have any other alternative method as well. This is the method that institute follows. Let the CRR be X, and the maximum amount that you can buy back, BB is buyback, is, let us say, Y. So if you formulate a simultaneous equation, you can say that, okay, my current equity base is 1800, out of which I can transfer some amount, that is X, to CRR. I can transfer some amount, let us say Y, utilize for the purpose of buyback. After taking both of them into consideration, my equity can be 500. It can't go below that, otherwise my debt to equity will be greater than 2:1. Therefore, you will formulate a simultaneous equation where it says 1800x is equal to, let us say, 1800 minus 500. If I take, I think that is 1300. So therefore 1300 minus x is equal to y. So this will be equation 1. Similarly, you will put another equation whereby you will take the maximum amount that you can spend for buyback, that is y rupees. Y rupees is the maximum amount you can spend for buyback. You will divide this by the buyback price. So let us say hypothetically the buyback price is 30 rupees. So this will give you the number of shares that you can buy back. And if there is no fresh issue, then the number of shares that you have bought back, that number of shares will reduce the capital base, and into the face value, let us say face value is rupees 10, into the face value, this will give you the amount to be transferred to the CRR. Therefore, if we solve this, y is equal to, let us say in this case, 3x, which is equation 2. Now, if you substitute equation 2 in equation 1, we can say okay 1300 minus x equals y. Acha, y ke jagah pe this will be 3x. Therefore 1300 equals 4x. Therefore x equals 1300 divided by 4, which comes to 325. Therefore y, so the transfer to CRR will be 325 and 325 into 3, which is 975, is the maximum resources that you can dedicate towards the buyback. But this is a rupee value. This is the rupee value. We want to figure out okay, how much can we buy back. Well, if we can spend rupees 975 towards a buyback, this is the number of shares. And for each share, you are going to spend 30 rupees. That is a buyback price, which means, loosely speaking, 32.5, you will ignore the decimal, but let us say 32.5 shares is the maximum shares you can buy back. Okay, in order to ensure that all the three limits are satisfied, you will take the lowest of the three. You can't just blindly buy back 32.5. What if your total number of shares are 100 only? Then 100 into 25% is the maximum 25 shares you can buy back. You can't buy back 32.5, otherwise the first condition will be violated. So you'll take the three conditions. The shares outstanding test, 25% of the share capital in number terms. The resources test, where you take 25% of the share capital plus reserves. And reserves over here are securities premium and free reserves. That will give you the rupee value that you can utilize for the buyback, divided by the buyback price will give you the number of shares you can buy back, and then through a 6-step procedure, you will try to find the maximum number of shares that you can buy back in such a way that the debt to equity does not cross 2:1. The actual buyback will be the lowest of the three share calculation, because the lowest of the three will ensure that all the three conditions are fulfilled. Okay, so that takes care of the questions involving buyback. Next, we have shares with differential rights. So when we look at shares with differential rights, the law says, so this is, I mean, you can refer these pointers over here. We have given these pointers. All of these have been explained. Acha, the exception, we have said that everywhere you are taking 25%, yes, but if there is board resolution only and no special resolution, then 10%. So how will we know in the exam? Well, in the exam, unless given, we will always check the limit based on 25%. This is what the institute has done. Acha, if the shares are with differential rights, then how do we solve these? Well, there is typically no question that the institute has put over it. It's more of a theory section. Shares with differential rights can be issued only for equity shares. Remember that preference shares cannot be issued with differential rights. Equity shares also, shares can be issued subjected to conditions, like it has to be authorized by the articles or memorandum. The shares that you are issuing at differential rights cannot be more than 26% of the combined share capital after the issue. You need to pass an ordinary resolution to get such an approval. And you need to be a fairly good company, that is, you have a distributable track record of profits, you have not defaulted in filing returns, you have not defaulted in the payment to creditors, to shareholders, their dividend, or you have not defaulted in any payment to courts or tribunals, etc. Only then will you be in a position to issue shares with differential rights. Sir, but what is differential rights? Well, differential rights are differing rights which can differ based on the dividend or based on the voting rights. So for example, in India, companies like Tata Motors, Jain Irrigation, Pantaloons, and internationally companies like Volvo, companies like Snapchat, your favorite, have issued shares with differential rights. In certain cases, shares have been issued with zero voting rights like Snapchat, or in certain cases, shares have been issued with differing rights given to the management like for Tata. In such cases, let's say there can be one share with zero vote, which is differing, ideally one share has one vote, or it can be one share with 10 votes given to the management. So these are shares with differential rights. Now in certain cases, these shares are issued, though they are not very common. They can be issued only for equity shares. For preference shares, there is fixed dividend and redemption value. Preference shares cannot be issued with differential rights. We have given the few conditions which are necessary. A theory question can come and has come on these grounds. And the last part where a practical problem can come is the calculation of a percentage stake. if preference shares also get voting rights. Sir, but preference shares don't get voting rights. Yes, usually preference shares don't have voting rights. However, if there are matters which concern preference shares interests, like an early redemption or an early conversion of preference shares, then preference shares get a right to vote on those resolutions along with equity shares. Or if you have if the preference shares dues like preference dividend or the principal is overdue beyond 2 years, or the company is in the process of winding up, then the preference shares get a right to vote in every resolution. But then how will you calculate the percentage voting rights? Well, for example, the company has 4 equity shareholders holding, for example, 30, 20 and 20. These are equity shares, percent stake, and you have preference shares which are held by X, Y, Z and W to the extent of, let us say, 40, 30, 20 and 10. Total, if I go to see, the equity shares are 80 and the total preference shares, for example, are 40. Now there are various ways in which you can solve if you want to find the combined share capital and voting. Here there are no differential voting rights. One can say that, okay, the total share capital is around 120. So out of 120, how much will A get to vote? How much will X get to vote, etc. So what does the institute do? The institute over here actually directly takes a ratio. It says 30% of what? Well, it is 30% of equity share capital, but equity share capital represents 80 out of 120. So equity share capital represents 80 out of 80 plus 40, that is 120, that is basically 2/3, whereas preference share capital represents 40 out of 120, that is basically 1/3. So we can say that, okay, I have a 30% stake, but that 30% stake is out of 2/3 of the share capital. Total 2/3 everywhere. So we have taken for the equity stake the total proportion of equity in the total share capital, and for preference it is 1/3. So this is 1/3, 1/3, 1/3, and as a result this will give me let's say 30 into 2/3, which comes to, let's say, I think 20% for simplicity. 20 into 2/3, which is 13.33%. Then for the preference shares you will have 40 divided by 3, which is 13.33%. 30 divided by 3, which is 10%. This is, I think, 6.67%, and 3.33% करेंगे तो you will get the total voting percentage for equity as well as preference shareholders. So this is what we have explained, that in such cases, if you want to find the voting percentage, you will take the equity stake and multiply it by the equity capital upon the total. If you want the preference stake, preference capital upon the total, because both of them are going to get a voting right share over here. Okay, so this takes care of buyback. I hope this quick revision video has been helpful to you. Thank you very much, and I'll see you soon. Bye bye. Take care.